So, when you think about planning your estate, you probably picture a pretty standard will, right? But here's a question. In today's world, is that simple document really enough to protect the legacy you've worked so hard for? Today, we're going to dive into a powerful tool that's kind of like a suit of armor for your family's inheritance, the Testamentary Trust. But are you really confident your will has every single angle covered? Because, without the right structure in place, even the best intentions can sometimes lead to some pretty devastating outcomes. Let's look at a real-world example to see exactly why this matters so much. Let's talk about Phoebe. For asset protection reasons, her family home was only in her husband Marcus's name. And this is where the trouble started, because Marcus passed away very suddenly, and he hadn't left a will. Because Marcus died intestate, which is just the legal term for dying without a will, the law, not his wishes, decided how his assets were split. A huge chunk of the family home legally went to their adult daughter, Meredith. And when Meredith refused to give her share back to her mom, Phoebe was faced with the absolutely heartbreaking prospect of having to sell her own home just to pay her daughter out. Phoebe's story is a tough one, and it really highlights the danger of having no will at all. But what if you do have one? Is that always enough to keep you in the clear? Well, let's look at another case. This time, the person involved actually did have a will, but one simple, tiny mistake had massive consequences for who ended up with what. Okay, so meet Gerald. He used one of those simple do-it-yourself will kits. He left specific things like his house and bank account to his favorite brother, Stan, but he didn't quite understand the term residuary estate, which basically means everything else. So he just left that section blank. Years later, he got a big inheritance, and when he passed away, that new money wasn't covered by his will. So what happened? The law kicked in, and that inheritance was split between his favorite brother and an estranged brother he hadn't spoken to in years, the exact opposite of what he wanted. So, we've seen the problems, we've seen the potential nightmares. Now let's talk about the solution, a really powerful structure known as a testamentary trust. So what is it? Put simply, a testamentary trust is a trust that you create inside your will, and it only springs into existence after you pass away. Instead of your beneficiaries getting their inheritance paid directly into their bank account, the assets go into this trust, which is then managed for their benefit. Think of it like a secure vault for their inheritance with a rule book that you've written yourself. Now, this is something that trips a lot of people up. They get it confused with a standard family trust. But the key difference is all about timing. A family trust is set up during your lifetime and operates while you're still alive. A testamentary trust, on the other hand, just sits there, dormant inside your will, until it's activated when you die. Okay, so now that we know what it is, why on earth would you want one? Let's break down the 3 biggest benefits, and trust me, they're pretty compelling. Benefit number 1, and for a lot of people, this is the big one: asset protection. Look, life is unpredictable. An inheritance that's given directly to a beneficiary can be exposed to all sorts of risks. We're talking business troubles, creditors, even messy relationship breakdowns. The great fear for anyone making a will is that the inheritance they leave behind will be attacked or lost. A trust acts like a shield, because technically the beneficiary doesn't own the assets. The trust does. Let's see what that protection looks like in a real-life situation. So Marianne was really worried her daughter Stevie's inheritance would be lost if Stevie went bankrupt. So her will placed that inheritance into a trust, and she made her other daughter the independent trustee. This meant the assets were held by the trust, not by Stevie personally. So when creditors did come knocking on Stevie's door, her inheritance was completely shielded. It was safe, allowing the trustee to use the funds for things like her kids' school fees. The legacy was secure. All right, benefit number 2. This one is huge. We're talking about tax. Testamentary trusts can offer some really significant and completely legal tax advantages, especially when there are young beneficiaries involved. You see, under normal Australian tax law, any investment income that's earned by a child under 18 gets taxed at the highest possible penalty rates. It's basically designed to stop adults from trying to split their income with their kids just to dodge tax. But here's where the magic of a testamentary trust kicks in. Income from one of these trusts has a really unique advantage. The law treats child beneficiaries as if they are adults for tax purposes. This means they get the full adult tax-free threshold. So on, say, $20,000 of income, that's the difference between paying thousands in penalty tax and paying pretty much nothing. The savings can be absolutely massive. And the third key benefit is just the sheer flexibility and control it gives you. You actually get to set the rules from beyond the grave, tailoring the trust to protect your family's unique circumstances. So what this means is you can protect a beneficiary who might be vulnerable, maybe due to a disability, an addiction, or, just being really bad with money. You can stagger their inheritance so they don't get it all in a lump sum at age 18. You can even specify that the funds should be used for particular things, like a house deposit or for their education. It just provides that peace of mind that your legacy will be a blessing, not a burden. Okay, so with all these powerful benefits, you're probably thinking, all right, what's the catch? And you're right to ask. A testamentary trust isn't a simple set and forget solution. It definitely comes with its own complexities that need some careful thought. The main downside is that they do add a layer of admin. A trust is its own legal entity, so it needs its own tax file number. And it requires a separate tax return to be lodged every single year, which, of course, comes with annual costs. And I really can't stress this enough, by far the biggest consideration, the most critical decision you will ever make with one of these is all about control. Who is going to be in the driver's seat of this trust you've created? Within a trust, you've got two key roles. First, there's the trustee. Think of them as the CEO, the day-to-day manager. They handle the investments and distribute the money. But then you have the appointer. The appointer is the ultimate boss. They're like the chairman of the board. They have one incredibly important power. They can hire and fire the trustee. Getting that choice wrong can undermine the entire structure. So let's bring this all together. We've seen how easily things can go wrong and the powerful protection a trust can offer. So what are the key things to remember from all of this? So to recap, a standard will isn't always enough. A testamentary trust adds this vital layer of protection for your assets against life's uncertainties. It offers major tax benefits and gives you tailored control, but its success really hinges on one thing: choosing the absolute right people to be in charge. At the end of the day, your legacy isn't just about the money or property you leave behind. It's about providing security, opportunity, and peace of mind for the people you love. The real question is, what steps are you going to take to make sure that legacy is truly protected? This is a complex area, so getting expert legal and financial advice is always the best next step.